Welcome to the first lecture of the Advanced Financial Management AFM series, tailored specifically for ACCA candidates and finance enthusiasts alike. In this inaugural session, we embark on a journey through the intricacies of financial strategy and management within a global context. Key topics covered: 1. Introduction to Advanced Financial Management AFM. 2. Strategic financial decision-making and its impact on organizational success. 3. Analysis of risk and return in financial management. 4. Capital structure theories and implications for business operations. 5. Techniques for financial performance evaluation and management. 6. International financial markets and their influence on corporate finance. Advanced Financial Management AFM is a specialized field within finance that delves into complex financial strategies and decisions aimed at maximizing shareholder value and achieving sustainable growth for organizations. This branch of finance builds upon foundational principles from corporate finance and investments, but focuses on more intricate scenarios and sophisticated techniques. Key areas of focus in AFM: financial strategy and policy. AFM involves crafting financial strategies that align with organizational goals and market conditions. This includes decisions on capital structure, dividend policy, and risk management strategies. Advanced financial analysis. In AFM, financial analysis goes beyond basic metrics like ROI and NPV. It involves advanced techniques such as option pricing models, real options analysis, and scenario planning to evaluate investment opportunities and risks. Corporate valuation. Valuation in AFM encompasses methods such as discounted cash flow, DCF, relative valuation, comparable company analysis, and valuation of intangible assets. Understanding these methods is crucial for making informed investment and financing decisions. Corporate risk management. AFM deals extensively with managing financial risks, including market risk, credit risk, and operational risk. Techniques like derivatives hedging and portfolio diversification are used to mitigate these risks effectively. Mergers and acquisitions. AFM covers the financial aspects of mergers, acquisitions, and corporate restructuring. This includes valuation of target companies, financing the transaction, and integrating the acquired assets post-merger. International financial management. Globalization has made international financial management a critical aspect of AFM. It involves managing currency risk, understanding international taxation, and navigating regulatory environments in different countries. Financial modeling. AFM heavily relies on financial modeling to forecast future financial performance, assess investment opportunities, and conduct sensitivity analyses. Advanced Excel skills and knowledge of financial modeling software are often required. Career opportunities in AFM. Professionals specializing in advanced financial management can pursue various career paths, including corporate finance analyst, analyzing financial data, preparing financial reports, and making recommendations to improve financial performance. Investment banker, advising corporations and governments on financial strategies, mergers, acquisitions, and raising capital through equity or debt. Financial consultant, providing expert financial advice to businesses on investment decisions, risk management, and financial planning. Risk manager, identifying and managing financial risks within organizations, ensuring compliance with regulations, and optimizing risk-return trade-offs. Treasury manager, managing liquidity, cash flow, and financial assets of a company, including overseeing investments and managing banking relationships. In conclusion, Advanced Financial Management AFM is a dynamic field that requires a deep understanding of financial theory, quantitative analysis skills, and strategic thinking. Professionals in AFM play a crucial role in guiding organizations through complex financial challenges and opportunities, contributing to long-term financial sustainability and growth. Strategic financial decision-making in Advanced Financial Management AFM is pivotal for organizational success, influencing various aspects of a company's operations, growth trajectory, and overall sustainability. Here's a detailed discussion on how strategic financial decisions impact organizational success in AFM. 1. Capital structure optimization. Definition: strategic decisions regarding the mix of equity and debt financing. Impact: Optimizing capital structure can lower the cost of capital, improve financial flexibility, and enhance shareholder value. AFM techniques like Modigliani-Miller theorem guide decisions on leverage and financing options. 2. Investment decisions. Definition: evaluating and selecting investment opportunities. Impact: effective investment decisions can drive growth, increase profitability, and expand market share. AFM employs tools like NPV, IRR, and risk-adjusted return metrics to assess project viability and ensure alignment with strategic goals. 3. Dividend policy. Definition: determining how profits are distributed to shareholders. Impact: a well-defined dividend policy signals financial health and stability, influencing investor confidence and stock valuation. AFM considers factors like cash flow, earnings stability, and growth prospects when formulating dividend policies. 4. Risk management. Definition: identifying, assessing, and mitigating financial risks. Impact: effective risk management safeguards against potential losses, enhances resilience during economic downturns, and preserves stakeholder trust. AFM utilizes techniques such as derivatives, insurance, and diversification to manage risks proactively. 5. Mergers and acquisitions. M&A. Definition: evaluating opportunities to merge with or acquire other companies. Impact: strategic M&A decisions can lead to synergy benefits, expanded market presence, and improved competitive positioning. AFM assesses financial viability, integration challenges, and potential synergies to maximize shareholder value. 6. Financial forecasting and planning. Definition: projecting future financial performance and planning resources. Impact: accurate financial forecasting aids in resource allocation, budgeting, and strategic decision-making. AFM leverages sophisticated models and scenario analysis to anticipate market trends, manage cash flow, and optimize resource allocation. 7. International financial management. Definition: managing financial operations in a global context. Impact: strategic decisions regarding international expansion, currency exposure management, and regulatory compliance influence profitability and operational efficiency. AFM considers geopolitical risks, exchange rate fluctuations, and cultural factors when making international financial decisions. Conclusion: strategic financial decision-making in AFM is not just about managing finances, it's about aligning financial strategies with broader organizational goals and market dynamics. By integrating advanced financial theories, quantitative analysis, and strategic insight, AFM professionals contribute to organizational success by optimizing capital structure, driving growth through prudent investments, managing risks effectively, and navigating complex financial landscapes. Ultimately, strategic financial decisions in AFM are pivotal in shaping organizational success by fostering financial stability, resilience, and sustainable growth in competitive markets. In advanced financial management, AFM, the analysis of risk and return plays a critical role in decision-making processes. Understanding the relationship between risk and return allows financial managers to make informed choices that align with organizational objectives and investor expectations. Here's a detailed analysis of risk and return in AFM. Risk in financial management. 1. Types of risk. Systematic risk, also known as market risk. It affects the entire market or a specific segment. Examples include interest rate fluctuations, inflation, and geopolitical events. Unsystematic risk, also called specific risk, it pertains to risks inherent to a particular company or industry. Examples include management issues, labor strikes, and technological changes. 2. Measurement of risk. Beta coefficient measures a stock's sensitivity to market movements. Systematic risk. Standard deviation measures the volatility of returns. Total risk. Credit ratings assess the creditworthiness of debt instruments. Credit risk. 3. Risk management strategies. Diversification, spreading investments across different assets or sectors to reduce unsystematic risk. Hedging, using derivatives like futures or options to offset potential losses from adverse price movements. Insurance, transferring risk to insurance companies to protect against specific risks like property damage or liability. Return in financial management. 1. Types of return. Expected return. the anticipated return based on historical data and future expectations. Realized return, the actual return earned on an investment over a specific period. Risk-adjusted return, adjusts the return for the level of risk taken. Common measures include Sharpe ratio, Treynor ratio, and Jensen's alpha. 2. Factors influencing return. Interest rates. Higher interest rates generally lead to higher returns on investments like bonds and savings accounts. Economic conditions, economic growth, inflation rates, and industry performance impact investment returns. Company performance, revenue growth, profitability, and dividend policies influence stock returns. Market sentiment, investor confidence and market expectations drive stock market returns. Risk-return trade-off. 1. Relationship. Generally, higher returns are expected for taking on higher levels of risk. Investors and financial managers assess the risk-return trade-off based on their risk tolerance, time horizon, and investment objectives. 2. Portfolio management. Efficient frontier, the optimal portfolio mix that offers the highest expected return for a given level of risk, or the lowest risk for a given level of return. Asset allocation, balancing investments across asset classes, for example stocks, bonds, real estate, to achieve desired risk-return profiles. Conclusion: in AFM, the analysis of risk and return is fundamental to making sound financial decisions. Financial managers use various tools and techniques to quantify risk, assess potential returns, and optimize portfolios to achieve organizational goals and meet investor expectations. By understanding the intricacies of risk and return, AFM professionals can effectively navigate dynamic financial markets, manage uncertainties, and capitalize on opportunities for sustainable growth and profitability. In advanced financial management, AFM, capital structure theories provide frameworks for understanding how businesses should finance their operations through a mix of equity and debt. These theories offer insights into the optimal balance that maximizes shareholder wealth and minimizes the cost of capital. Let's explore some key capital structure theories and their implications for business operations in AFM. 1. Modigliani-Miller, M&M theorem. Theory: the M&M theorem, in its pure form, asserts that in a perfect market without taxes, bankruptcy costs, or asymmetric information, the value of a firm is independent of its capital structure. It suggests that the cost of capital remains constant regardless of whether a firm finances itself with equity or debt. Implications: irrelevance of capital structure. According to M&M theorem, under ideal conditions, capital structure decisions do not affect firm value. This implies that businesses can choose any mix of debt and equity without impacting their market value in a perfect market scenario. Practical applications: while real-world markets are not perfect, the M&M theorem provides a benchmark for evaluating the impact of capital structure decisions on firm value, particularly in understanding the cost of capital implications. 2. Trade-off theory. The trade-off theory posits that firms balance the benefits of debt, such as tax shields from interest payments, against the costs, such as bankruptcy risk and financial distress costs. It suggests that there is an optimal level of debt that maximizes firm value by minimizing the overall cost of capital. Implications: optimal capital structure. Firms seek to find the right balance between debt and equity to maximize their value. This involves considering tax advantages of debt while managing the risk of financial distress. Dynamic nature. The optimal capital structure may change over time due to shifts in market conditions, business risks, and financial performance. AFM involves continuous evaluation and adjustment of capital structure based on these factors. 3. Pecking order theory. The pecking order theory suggests that firms prefer internal financing, retained earnings, over external financing, debt and equity, due to information asymmetry between managers and investors. When external financing is necessary, firms prefer debt over equity to minimize signaling costs. Implications: financial policy. Businesses tend to rely on internal funds first and resort to debt issuance only when internal resources are insufficient. This can lead to a conservative approach to capital structure, emphasizing stability and avoiding dilution of ownership. Impact on operations: by prioritizing internal financing, firms may have more control over their operations and strategic decisions without being overly reliant on external stakeholders. 4. Agency cost theory. The agency cost theory focuses on conflicts of interest between shareholders, principals, and managers, agents. It suggests that higher levels of debt can mitigate agency costs by aligning managerial interests with those of shareholders through debt covenants and financial discipline. Implications: monitoring and control. Debt financing can impose discipline on management, as lenders often require financial reporting and adherence to covenants. This can lead to improved operational efficiency and strategic decision-making. Risk management. Higher debt levels can increase financial leverage and amplify returns to shareholders during periods of economic expansion, but also increase the risk of financial distress during downturns. Conclusion: in AFM, understanding capital structure theories is crucial for making strategic financial decisions that optimize firm value, manage risks, and align with business objectives. Each theory offers unique insights into how businesses should structure their financing mix based on market conditions, risk tolerance, and growth opportunities. By applying these theories effectively, financial managers can enhance operational efficiency, mitigate financial risks, and maximize shareholder wealth over the long term. In Advanced Financial Management, AFM, techniques for financial performance evaluation and management are essential tools for assessing the effectiveness of financial strategies, making informed decisions, and maximizing shareholder value. Here are some key techniques commonly used in AFM. 1. Ratio analysis. Definition: ratio analysis involves calculating and interpreting various financial ratios that provide insights into different aspects of a company's performance, profitability, liquidity, efficiency, and solvency. Key ratios: profitability ratios, such as return on equity, ROE, return on assets, ROA, gross profit margin, and net profit margin, which assess the profitability of the company. Liquidity ratios, such as current ratio and quick ratio, which measure the company's ability to meet short-term obligations. Financial leverage ratios, such as debt-equity ratio and interest coverage ratio, which evaluate the company's debt management and financial risk. Implications: ratio analysis helps identify trends, compare performance against industry benchmarks, and diagnose financial strengths and weaknesses. 2. DuPont analysis. Definition: DuPont analysis breaks down the return on equity, ROE, into its component parts: net profit margin, asset turnover, and financial leverage. This provides a detailed understanding of what drives a company's profitability and efficiency. Implications: by analyzing these components, financial managers can pinpoint areas for improvement in operational efficiency, profitability management, and capital structure optimization. 3. Cash flow analysis. Definition: cash flow analysis involves examining the inflows and outflows of cash within a company over a specific period. It helps assess the company's ability to generate cash from operations, maintain liquidity, and fund investments. Techniques: includes cash flow statement analysis, free cash flow calculation, and cash conversion cycle analysis. Implications: cash flow analysis is crucial for monitoring financial health, planning capital expenditures, evaluating dividend policies, and assessing financial flexibility. 4. Variance analysis. Definition: variance analysis compares actual financial performance against budgeted or expected performance. It identifies differences, variances, and investigates the reasons behind them. Implications: enables financial managers to control costs, improve budgeting accuracy, and make timely adjustments to operational strategies based on deviations from expected outcomes. 5. Economic value added, EVA. Definition: EVA measures a company's true economic profit by deducting the cost of capital from its net operating profit after taxes, NOPAT. It indicates whether a company is generating returns above its cost of capital. Implications: EVA aligns financial performance with shareholder value creation, encourages efficient capital allocation, and serves as a performance metric for evaluating managerial decisions. 6. Budgeting and forecasting. Definition: budgeting involves setting financial goals and allocating resources to achieve them, while forecasting predicts future financial performance based on historical data and market trends. Implications: effective budgeting and forecasting, facilitate planning, resource allocation, and risk management. They provide benchmarks for evaluating actual performance against planned goals and making adjustments as needed. 7. Risk-adjusted return measures. Definition: risk-adjusted return measures, such as Sharpe ratio, Turner ratio, and Jensen's alpha, assess investment performance relative to the risk taken. They adjust returns for the level of risk assumed by investors or managers. Implications: help financial managers evaluate investment opportunities, compare performance across different assets or portfolios, and make decisions that balance risk and return objectives. Conclusion: in AFM, these techniques for financial performance evaluation and management provide a comprehensive toolkit for assessing operational efficiency, profitability, risk management, and shareholder value creation. By leveraging these techniques effectively, financial managers can enhance decision-making processes, optimize resource allocation, and navigate complex financial landscapes to achieve sustainable growth and competitive advantage for their organizations. International financial markets exert significant influence on corporate finance within the realm of advanced financial management, AFM. These markets provide avenues for global capital flows, investment diversification, and risk management, thereby shaping corporate finance strategies and decisions in several ways. 1. Access to capital. Global equity and debt markets. Multinational corporations can access a broader pool of investors and lenders through international capital markets. This facilitates raising funds at competitive costs, diversifying funding sources, and optimizing capital structure based on global market conditions. 2. Cost of capital. Impact of global interest rates. Changes in global interest rates affect borrowing costs for corporations in international markets. Financial managers monitor and adjust capital structure and financing decisions to capitalize on favorable interest rate environments or hedge against rising rates. 3. Currency risk management. Exchange rate exposure. Multinational corporations face currency risk due to fluctuations in exchange rates. AFM involves strategies such as hedging with derivatives, for example forwards, options, natural hedging through operations in multiple currencies, and financial instruments to manage currency risk exposure. 4. Financial instruments and products. Derivatives and structured products. International financial markets offer a wide range of derivatives and structured products for hedging risks, managing cash flow volatility, and optimizing investment returns. These instruments enable corporations to tailor financial strategies to specific market conditions and risk profiles. 5. Strategic decision-making. Mergers and acquisitions. M&A, international financial markets, facilitate cross-border M&A activities, allowing corporations to expand into new markets, acquire strategic assets, and capitalize on synergies. AFM involves evaluating financing options, regulatory frameworks, and integration strategies in diverse global contexts. 6. Regulatory and legal considerations. Global compliance standards. Corporations operating in international markets must navigate diverse regulatory environments, tax regimes, and legal frameworks. AFM includes managing compliance risks, tax implications, and cross-border transactions to ensure legal and regulatory adherence. 7. Market integration and efficiency. Efficient capital allocation. International financial markets promote capital efficiency by directing funds to regions or sectors with growth opportunities and attractive returns. Financial managers utilize market information, pricing efficiencies, and capital flows to optimize investment decisions and allocate resources effectively. 8. Global economic conditions. Impact on financial strategies. Global economic trends, geopolitical events, and macroeconomic policies influence corporate finance strategies. AFM involves monitoring economic indicators, assessing market sentiment, and adapting financial strategies to mitigate risks and capitalize on opportunities in a dynamic global landscape. Conclusion: in AFM, understanding the influence of international financial markets is crucial for corporate finance practitioners. These markets provide opportunities for capital raising, risk management, and strategic expansion on a global scale. financial managers must navigate complexities such as currency fluctuations, regulatory challenges, and market volatility, while leveraging international financial markets to optimize corporate finance strategies and enhance shareholder value in a globally interconnected economy.